Hello, everyone. Thanks for joining this recorded webinar. We have myself, Mitch Miller, and Austin Kinchin from Bull and Bear Investments. We also have Sam Silverman from Silverman Capital and Seif from Techvestors. Let's hand it off to Seif to get this started.
Hey, everybody. I'm happy to kind of walk you guys through a little bit about what we're doing in the short-term rental space and what makes us really excited about where we're at. So kind of just to hop right into things, the big idea behind why we started Techvestor and really the short-term rental fund is we wanted to bring a institutionalized type approach and a syndication type approach to the world of short-term rentals, given how hard they are to operate. You never want to be a landlord, a designer, or a manager, and find it and deal with a lot of crazy things that happen in the STR space sometimes. 300,000 miles away. So we built a short-term rental fund, very much like a syndication that you guys might be used to with apartments or office and some other commercial products that allow you to invest with us super passively in a way that allows it that it's passive, immediate cash flow, baked in appreciation, all the tax benefits that come with it. And what's really awesome, I think, about this short-term rental fund, and really what doesn't exist really anywhere else, is this instant diversification piece. So short-term rentals, as you might imagine, are, you're not buying an $80 million short-term rental as you might with, say, an apartment building. So having real great diversification, both locally and also across state lines, for example, or in 8+ states, is a really, really big win here. In addition to the idea of not having any liability with taking out any of these loans. So in short, really what we're doing here is we are buying single family homes across the country, right? We are furnishing them, renovating them, designing them, operating them, and then we're going to hold them for a specific period of time, probably up to 5 years, cash flow those things, right? And then we're going to stabilize this portfolio and then eventually sell this portfolio either to a single large buyer, which is exactly what these large buyers want, right? The reason they haven't entered short-term rentals is they're like, hey, someone else do the work, stabilize the portfolio, bring me this great cash flow. It's been performing and I'll happily pay a premium for it. Alternatively, we could also sell this portfolio off individually, right? Chunks at a time, one-offs at a time, to retail investors for those similar premiums, because retail investors are also looking for stabilized yield. In fact, if you look at any turnkey real estate property website, you'll find that these cap rates that they're selling for are very much compressed when something has been stabilized. And Sam, if you want to hop in here a little bit on exits.
Yeah, so I think a really big thing to look at here is just how quickly we can exit properties when we want to, when looking at the kind of range of cap rates that we're seeing. So in our model, we're kind of averaging out a 7% cap rate upon exit. We're really seeing exits that are far more compressed than that. And keep in mind, these are also single assets that are being sold versus the full portfolio. Like Seif was saying, if you look at an institutional investor who's going to pay a premium, they can't go spend $50 million in short-term rentals today in terms of writing one large check. But essentially, you have to go buy property by property by property to buy them, renovate them, stage them, design them, and get them ready to really produce revenue. And it's a much more hands-on approach as each individual asset has to be built out. So what we really believe is that we're going to see massive compression when looking at the cap rates, the more properties and assets that we have in a single portfolio. We also have a nice diversity of how we can exit them, right? If you kind of look at our optionality, we can always sell off a single property to a retail investor. We can sell off a group of regional properties to a family office. We can sell off the full portfolio nationally to an institution, right? So we have a lot of different angles we can go take to maximize overall dollar returns for investors.
Yep, could not agree more. And we've got significant interest, from private equity groups. We've proven out the retail side. So we're really excited to see kind of where this goes. But a common question we also get is like, how did we get here, right? So let's talk a little bit of the story about what's really interesting about what we do and why we're really excited. Look, I come from a talent background. I spent 5 years at Facebook building teams, and Sabrina built AirPods over at Apple. And she really led that entire initiative. And one thing that we both recognized very early is we wanted to have the best operating team in the space, right? So we built that. We built the best operating infrastructure in the space, including things like key advisors from companies like AirDNA. AirDNA is the largest short-term rental data analytics firm in the space. Scott Shatford, their CEO, sits on our board. Rob Abasolo, who's on the host of the Bigger Pockets podcast, also sits on our board. We built our own software. We come from a tech background, and I think this is a huge key advantage that we have. So we built our own software that allows us to understand not only where to buy, but how to underwrite, how to design, where to furnish, and a little bit more on that later. We've raised over $17 million today since the inception of this first fund. 45 plus properties, like I've mentioned. We got really early mover upside here with continuous growth. So today we're going to talk a little bit about just the asset class, the performance, the track record thus far, the team, the technology, and then we're going to talk about money, right? How you make it and how we protect it. And the idea here is our goal is to double capital every 4 to 6 years, right? 5 years being kind of that general average range, and hit on around that 8 to 12% average cash on cash per year. We want you to do it passively. We want you to have instant diversification, and we want you to have tax benefits so you can keep more of that capital yourself. The asset class itself is really fantastic. I don't know about you, but I personally prefer short-term rentals. I have a family of 3 today and soon to be 4. So having space and kitchens and, staying local and not getting that typical hotel vibe when I'm in a city, those are all things that are very attractive to me about short-term rentals. The cash flow is significant, right? It's significantly better than single family rentals, and oftentimes much better than multifamily and some other asset classes. The tax benefits are fantastic. You can expect somewhere between 30 to 35% in terms of depreciation per dollar that you invest, right? But also you want to invest in a growing asset. So demand is outpacing supply considerably for short-term rentals, up 3 times just in this last decade, and accelerating heavily post-pandemic, right? Things like remote work, flexible living. All of these things are really, really driving towards this need and want to invest in and have more short-term rentals. One of my favorite things about the asset class is actually the competition, right? I don't know about you guys, how many times you want to enter a specific asset class because of the lack of competition. Here, this competition excites me. Why? Because it's mom and pops, right? They lack the management, they lack the design, they lack everything that we have. They lack the easy things that are somewhat reasonably quick to implement. They're still taking, photos on their iPhone 4 camera or designing very much similarly as if it was old, right, to say the least. We built a vertically integrated company that allows us to have great acquisition. We drive great revenue management, design. Operationally, we're incredibly fluid, and it shows. So thus far, we're exceeding projections in this portfolio. We're driving 42% more revenue than our competition, 52% more occupancy. All our live properties are forecasted to drive towards an 8.6 cash on cash or better. And we've achieved a 38 IRR on all exited assets. And the pipeline is looking good, right? So we got 3 more under contract. We got another 13 in the renovation setup phase. I think we're actually up to 24 live as of this recording, 7 exits thus far. You can actually click this link here in the deck and go to the Airbnb profile and see some of these listings. Just look how beautiful they are and how they come out, and they book because of those types of things. And a live look at performance, right? Our ADRs continue to increase. So ADR stands for average daily rate, right? So each and every month we're driving more and more revenue, because a fantastic thing about short-term rentals is you can drive rents, as the industry calls it, daily, nightly, monthly, right? Very much, and it's not annually, right? Where that's often the case in multifamily or things like commercial. We're achieving goal, right? We're getting above or near that 100th percentile right out the gate. I think this right here is a really good indicator of how things have been going, right? What we underwrite for is essentially what we've been hitting. August was an absolutely fantastic month, right? We're starting to see the beginnings of stabilization of past projects and earlier projects. A myth that we often hear is like, are people going to stay here, Seif? And yes, our occupancy shows that people want to stay here, right? We're averaging about a 73 to 75% occupancy pretty conservatively across our portfolio. In terms of an ADR, look, we don't want to compete with hotels. We're not typically buying things that we're going to charge, 99 bucks a night. In fact, we want our average ADR in our portfolio to be above 200 bucks. And we're so far just exceedingly crushing that. Call it inflation, call it what you want. Some of these properties, we never forecasted to get to these types of ADRs this fast.
Hey, Steve, can I ask a quick question for you?
Yeah, please.
Back on that slide, I know it's pretty obvious, but obviously on that one chart, September monthly book, right, looking below pro forma, obviously, 9-1, but can you just speak to that just for the investor?
Oh, yeah, happily. I'll do you one better. Let me take you to the back end of some data because I'm a big believer in data. And let me show you something about how we kind of track rev management. So let me kind of pull a couple things up. So here we are in September, right? We are already 93% of pro forma, right? And we're only 47% occupied, right? And by the way, these are some recently launched properties that we're still gathering a little bit of data on. But the great news here is that typically at the start of the month, we're already 85+% to pro forma. I mean, look at October as a forward look. We're already almost 50% to pro forma, right, in terms of goal. So in short-term rentals, because of what's called booking lead time, that's not a concern at all, right? So when we look at where we are in September, as of 9/1, we're entering the month already at 85, 5th percentile of pro forma. Does that answer the question a little bit?
Absolutely. I appreciate it. Thank you.
Yeah, of course. And I wanted to kind of bring that up because, what we've been seeing probably since, I would say since May or so. And I can even, since we're talking a little bit on data, let me kind of show you guys a little bit about what I mean by this. Where is it? We're going to have it right. I think it might be on the portfolio page. Here we go. Oh, lead times. So we track lead times by our properties, right? And booking lead time essentially is how far in advance is someone booking a property. And this is just the export of our backend operational software. It's a little easier to filter in Excel. Back in, say, Q1, we were seeing much longer lead times, right? So here you go, you see 49, 66, 62. Look what's been happening recently, right? You have almost like a 50% reduction in booking lead time. People are being more flexible. It's a economic and socioeconomic and behavioral shift in markets, right? All of a sudden, people are like, you know what? I can go wherever I want to go next weekend. And that's totally fine, right? They're not necessarily planning far in advance. And our pricing strategy has changed accordingly, right? So that's why the booking lead time, and that's actually a great call out why I have this date in here, right? Because this date is indicative of the data here. And this data changes daily, right? In terms of where we're at. And we look at where we're booking weekly. So hopefully that addresses some of those questions.
And just for a reference point, it's the 11th on the data.
Yes. Yeah, we have no, and we're also the data that you just saw, by the way, on revenue is a 1 week lagging. So every Sunday, our revenue management team will go ahead and update where we are at, and to kind of give you an idea of how things have been going recently. Just week over week. Last week we booked 47 bookings and had $58,000 in revenue, right? Just last week. So 9/5 to 9/11 right now, we're not accounting for anything at all, right? So if we have a similar type performance, right, as of last week, or even half of it, right, that'll put us awfully close, right? We're only about $7,000 away. So we should honestly pass it this week, to be quite direct. So we'll have another month that we exceed performance. Awesome. Okay, hopping back into things. Look, we've been doing this quite a while, right? Our portfolios, both personally and professionally, have been performing, both pre-COVID, during COVID, post-COVID, as many things people want to bring up, things that go right or wrong. We love short-term rentals because of the ability for us to drive performance against the competition that we typically deal with. And the data really shows that we've been really excelling at that since the beginning. I mentioned I come from a talent background, so I definitely want to touch here on team. Team is a big deal for us, and we believe it's one of our 3 strengths: team, technology, and traction. So Sabrina and I both come from tech, and that's why we wanted to apply a lot of tech to this kind of real archaic space. And our team in general is really fantastic. I mean, Sam's done nearly $1 billion, if not more, of real estate transactions himself. He's our head of capital markets. John's our head of data. So everything that you're seeing data related here, he's literally known as the Airbnb data guy in the industry. We recruited him heavily and got him to join. Taylor's our head of acquisition. He'd kill me if I didn't tell you to check out his Twitter. Drops up a lot of great knowledge there as well. Alan comes from Origin as well as Compass, and he's on our lead on our investor relations side as well. So advisors, we talked about people like Scott, who are currently at AirDNA and the CEO leading that company. You have people like Nico, who's the VP of product at Zumper. The reason Nico's really awesome is he's leading us and advising us on product, and I'll show you why here in our technology in a second. Laszlo is previously the SVP of analytics at Realtor.com. Really awesome because we have open access to the MLS, as well as he comes from a talent background himself. And this really allows us to understand our talent composition a little bit better. And of course, I mentioned Rob a little bit earlier. Let's talk about some fun things. Let's talk about software, right? Let's nerd out here for a couple minutes. We built software to do a couple things, right? We want to know what to buy, where to buy it, how to finance it. We also want to know how to operate it, if it's a sustainable market and what growth looks like, right? The reason we wanted to do that is because we wanted to understand where to buy, what exactly to buy in those markets. For example, you see that we're in places like Scottsdale, we're in places like Memphis, we're in places like Branson, Blue Ridge, Clearwater, right? Panama City Beach, the Poconos in Pennsylvania, the Hudson Valley of New York. By the way, these are all markets that if you were to invest, you'd have open access to day one instant diversification. But how do we know to enter those markets? How do we know what to buy in those markets? Let's take a little bit of a look on the back end here, right? So this is our back end software that allows us to essentially underwrite the entire country in real time as soon as a property hits the market, 60,000 plus times a month, automatically, right? And here's what the data tells us. 94% of the time when a property hits the market, the numbers don't work. And so oftentimes you'll see these big acquisition teams sifting through deals, especially in the single family space where it's not about spending 80 million, it's about spending 800,000, right? You would need these really large acquisition teams, which typically comes with a lot of fees. What we did is we built technology to automate 94% of the noise, right? And we can click into any one of these homes and, well, let's not use this one, and it's a condo. Let's step into one of these homes. We can actually pull all the data. We can instantly connect to AirDNA. They're one of our preferred partners. We see the rental income coming from comps. We have our own comp set on the back end, right? Giving you guys a little bit of a sneak peek about what that looks like. Here, let me pull up a screenshot. It's not live just yet, but this is our beta screen. So that's why I'm showing it here in our dev section. So we're able to pull comps up with confidence, right? In terms of a confidence score, in terms of the comps within a certain mile of a radius, we can filter it by bed bath count. We can see what they've been charging for ADR right here, right? We can see what they've been driving in revenue, how close they are, right? All of these things we can actually do manually, but my favorite part is we do them automatically, right? That's really the key here, is to understand where to buy before it's really a hot market, right? And then these things typically pop up in something like this. Like, for example, this is a little bit of a metro of Denver. We're understanding where kind of these things are being bought. Also, keep note here, you see how this is like metro Denver, like very downtowny, a lot of like sub 200 ADRs, things we want to avoid, right? As an example. One of my favorite things about our software, and I'll dive into it a little bit deeper here as well, is we know not only what to buy this at the city level, we know what to buy down to the neighborhood, street, zip level, right? So for example, this is in Scottsdale. And what you can see here is each dot represents a bedroom count, right? Blues being, 5 bedrooms, or this blue being the 5 bedrooms, 4 bedrooms being purple, etc. So if we were in this zip code, the difference between buying a 4 and a 5 is not super massive. However, you're definitely buying a 4 or a 5 over a 3, right? Because a price to rent ratio makes a lot more sense. In a market like this one, right, in this zip code, buying a 3 versus a 4 or a 5 is actually going to give you the largest arbitrage and price to rent ratio, right? Look at a market like this one. buying a 5-bedroom is by far the best thing to buy versus buying a 3 or a 4-bedroom. So we know exactly what to buy, and that's just the quantitative side, right? We know the qualitative things, like, does it need to have a pool? Does the pool need to be heated, right? Does it need to have a big backyard? What do the amenities need to look like? Right? All of these things are absolutely being driven and understood by our data. And if we kind of come back a little bit here, let me show you a little bit about how that's happening. So things like this right here under amenities, we're using machine learning to understand and categorize and store this data so we can in the future correlate things like, does the word view correlate with higher or lower cash on cashes, right? As an example. And then if we come over here to understand our markets, like we're market mapping 250 plus markets at any given time, right? And again, this is our development scene. So some of this is just for test purposes. But if I want to enter, say, Clearwater, right, as an example, I brought that up earlier. So here we've been mapping the market since February. We see that we've had a consistent scale of market, right? Meaning supply has been fairly consistent over time. We see that in this market, what comes on market, what people are selling, are predominantly 2 and 3 bedrooms. We can also see that typically what makes sense to sell and what makes things to buy in terms of an STR is not a 2 or 3 bedroom, making this a very difficult market to enter. In fact, the data shows that your larger homes, your 5, 6 bedroom homes, are the ones to buy in the area. So for example, in a lot of our Clearwater homes, you'll see that we can sleep 12, 14 plus people. Why? Because we need to be able to compete in that niche, right? So that's a little bit of a tease on the back end here on data. I love nerding out on those types of things at any time. But kind of just continuing here. Look, we call it a 16-point checklist of things that we typically look for, right? The biggest things typically are going to be things like seasonality. We want tax-friendly states in many cases. We're looking for a place where we can absorb really great occupancy and drive really great competition. So for example, a market like Scottsdale is highly competitive for short-term rentals, even though we excel heavily. While a market like Clearwater is good, but lacks incredible design and low ROI and low hanging fruits that in the current market with how it's being underwritten versus what we're able to do, right? And those are the types of things that we're able to drive in terms of design, experience, amenities, with everything that's kind of going on. So let's kind of step into a little bit of understanding our vertical integration. So, we handle everything from acquisition to design to property management to rev management. Everything is built in-house, right? We're the only company in the entire country that works with investors in this type of format that does this on a national scale. We can be in any market if it made sense within about 2 weeks, right? And we're continuously underwriting the data to understand where it makes sense. We pride ourselves a lot on design and data. You often heard me say these things over the last probably 15 minutes because it matters a lot, matters really a lot. Take, for example, this Scottsdale home, right? We bought it. It's actually an existing STR. So this is a great case study. Existing STR, lacked a lot of great design, okay? It was already pulling about 140 grand a year. Right now it's projected to do over 200 grand, $60,000 or about a 40-ish% increase in revenue with just really great design and even better management. Take, for example, this Poconos cabin. We took from, wow, this is dingy to, wow, this is industrial airy, right? Does not really exist in this market. But who comes here? We're getting a lot of like East Coast, New York crowd, DC. They love the industrial vibe. Look at this Scottsdale home. You look at it and you're like, first of all, how many times do you see a model in your photos on Airbnb? It's rare, right? You see the pops of color, you see the baby pink cabinets. Clearly, we're attracting a bachelorette type theme or type party here. In fact, since going live, this property has, I believe, gone over a dozen reservations. This just went live, I think, about a week ago or so. All of them big parties, typically coming to celebrate something of those things, right? 12 women coming here to celebrate bachelorette, celebrate something, right? We're attracting the type of clientele we want, and we're getting and fetching the revenue that we want because we're providing an experience. Take, for example, the Stock Tank Paradise in Memphis. Very modern design, modern aesthetic. You got a pool in the back, beautiful scenery, incredible kind of speakeasy type vibes right in the back. All of these types of things are things that we drive in our design. And of course, sometimes just clean, minimalist, modern design wins as well. Okay. So happy to kind of go into the numbers here, Austin, Mitch, or do you guys want to kick it over to you?
Yeah, you can go into the numbers. I think we're good with that.
Sweet. Awesome. So like, 25K minimum, projected 5-year hold. We're looking at exiting between years 4 and 5. 100% of the tax benefits are shared with our LPs. Quarterly cash flow, so you can expect that check in your, to your bank account just automatically. No snail mail here. 8 to 12% annualized cash on cash as a 5-year average. We're looking at doubling equity every 4 to 6 years, typically around that 5-year hold. We don't charge any AUM fees, any capacity. We're fully diversified across 8 states and 45 plus properties. If you're unaware of how things like depreciation work, it's really fantastic, right? With real estate, even though it appreciates, you can depreciate it, right? The government tells you over 27.5 years, typically in the residential space. And if you do what's called a cost segregation study, you can accelerate that depreciation schedule and take what's called bonus depreciation, simply by think of it as having an inspector go to your house or having software do it, and line iteming everything, the nuts, the bolts, the doors, the windows, and some of those things can be accelerated even faster. That's why you're seeing a much larger depreciation loss in year 1. When I say loss, it's not about losing actual money. It's about taking a paper loss that allows you to offset taxable income, right? So if you're a high income earning W-2 employee or anyone else, or maybe you're a real estate professional and you're looking to offset these types of things, anytime you can offset with depreciation is always a really fantastic thing.
Hey, Steve, any reason here you've got it out to 10 years just for investors?
Yeah, great question. So we just model out based on 10. So people always ask, like, what's our worst case scenario? And I'm like, look, if, I don't know, World War III, COVID happens in, year 4.5 and we're looking to exit, and, can we hold for 5 years in our model, and are we forced to exits? So I want to actually jump to talking about protecting your downside and protecting your capital, and why we always look at a 10-year schedule instead of a 5. So while we have full intention of exiting before 10 years and exiting within that 4 to 6 range, all of our debt is 10 years or longer. All of it is fixed for 10 years or longer. We don't have balloon payments, no surprises, right? Here's why. Go back to 2008. 95% of all mortgages, people who kind of drove the crash, one might call it, right? Those types of things. The reason that happened is because they were forced sellers in a bad time. 95% were adjustable rate mortgages, balloon payments, at a time when the market dipped aggressively due to poor lending, among other things. So we never want to be forced sellers. Our worst case scenario is that we hold for 10 years. We sell our properties based on value, not revenue. We have the fixed debt to support it, so we're never forced sellers, and we achieve low double-digit IRRs. That's our worst case scenario in terms of how we model this, right? And not only are we doing that, that's not even factoring in the forced equity that we're adding to each and every single property at acquisition, right? We're typically doing pretty extensive rehabs and designs. The designs I just showed you are typically, we're not buying turnkey, right? We're making that experience kind of come to life. So answer your question a little bit about why we do look at a 10-year schedule in terms of, a hedge.
Yeah, absolutely. I think that's hits the nail right on the head. And obviously, the beauty of real estate, right? We want to make sure we're hedging against those things, and obviously conservative underwriting is something that we've, prided ourselves on for years, Mitch and I. And so, glad to see that in a partner as well.
Of course, we always want to make sure we kind of have that baked in. And look, at the end of the day, you also get owner stays. So if you get to stay in any of these properties for the next decade as kind of your worst case scenario, it may not be the worst thing, right? Also getting that nice cash flow and being able to use them. Our investment actually has utility. So if you or your family would like to come stay, a friend, feel free to just email us. We have a concierge, we'll book direct. We avoid these Airbnb platform fees. That's actually why it doesn't impact the investment itself. So it doesn't impact the financial side of things. But hey, it's kind of nice. If you want to go to Scottsdale, stay in the Barbie Pink House, or head out to the Poconos, or go to Memphis or Clearwater or Panama City Beach, and you want to stay in one of the properties where you're an owner, you're a partner in, we welcome that as well. Last but not least, a couple of things that I want to hit on. People ask, is there more competition coming into this space? We fully expect it, right? We fully expect as this space continues to mature and institutionalize over time, that we'll see more and more competition. The good news is we have a really hard infrastructure to compete with, right? Our acquisition is one of the best from a technological perspective. Management, vertically integrated completely. Our revenue management is one of the best in the country. You saw it by 52% better occupancy and 42% better revenue. Operationally, we're not like these huge public companies where we don't pay attention to our properties, right? We have really great service-oriented team members who are really driving the experience, right? In addition to that as well. And look, at the end of the day, I also like to remind us that we're underwriting really conservative to the market. If you go on companies like Roofstock's website, they're selling short-term rentals for anywhere between 1 and 5 caps. Now, I do not believe that that is where the market is today, but that is where some of their properties have sold. We underwrite for exits between 6 and 8 caps, right? And so we have such room to run, especially over the next 3, 4, 5, 6 years, that the upside in an investment like this is really fantastic. Last but not least, look, you can expect really great transparent experiences with us, right? Quarterly reporting, quarterly distributions. It's a totally passive experience. There's a beautifully built portal that you can kind of go in and see what all the updates look like, what all the assets are. And look, I come from a tech background, so everything that we do has to be scalable. So whether we're doing 10 STRs or 1,000, it really is fantastic to see a portfolio like this grow over time. Austin, Mitch, I know you guys have been really fantastic as well, and your investors will be able to invest with you multiple times throughout the year, especially if things are going well and they have excess capital to do that as well. But yeah, this has been really awesome and fun, and happy to answer any questions. But that's a wrap, fellas.
Awesome, thanks, Steve.
Yeah.
Yeah, no, really, I think, this really hit all the questions we have, a lot of the questions we've had from our investors in the past. I have no additional questions. I do want to thank you for your time. And, I know you guys are always open for more questions. So, for anyone watching this, if there are additional questions, always feel free to email us, and we are happy to get those answered for you.
Yeah, anytime.
Before we hop off, is there anything else anyone wants to hit on? All righty. Well, thanks everyone for your time.
Cool. Thanks, fellas. Have a fantastic week.